Hey there, welcome to the channel. This is on the morning, Monday morning, about 8 a.m. on Pacific time. So it's about 11 a.m. on New York time. And just want to go over the market today a little bit. We have another sell-off going on right now, pretty broad-based across all the indices. And going back to the big picture, if we look at the SPY, we can see that, okay, now it's like selling below the 50-week moving average, the 200-day moving average. And then if we look at like the NASDAQ, see what that guy's doing. We can see that, it's continued to kind of go down lower, and then Dow Jones Industrials continuing to go down below its moving averages, and then the IWM here, this guy continue its descent. We have a little doji thus far, but we're in the middle of the trading day, so who knows? It could have a big reversal or whatever. Given that there's been so much oversell, things are kind of really getting oversold here. You wouldn't be surprised to have some quick and sharp rallies coming up. But the big picture is, the Fed meeting is happening tomorrow and the day after, and they usually their statement comes out at 2 o'clock East Coast time on Wednesday. So we'll see what they say. I think there's been a lot of speculation in the market that the Fed is going to stop their tapering early, or not, that they're going to cut their bond purchases off sooner than expected. Currently they were tapering the bond purchases off a certain amount every month, such that in March or April they would be at no bond purchases and then be ready to raise rates. And then the speculation now, there's some thought that, well, maybe they're going to speed this up and just stop buying bonds altogether now, et cetera, et cetera. I don't know. It's really hard to say. Obviously, this says a lot, right? The market that we're in is like everyone hangs on the Fed's word. Why is that? Well, because they have control over the cost of capital. So it's a huge thing. Anything they do will have a huge effect on the entire economy. So that will affect all the companies, it'll affect the stock market, the whole darn thing. So that's why everyone just hangs on their word. From my perspective, I don't think that they would necessarily change that. I mean, if they said they were going to taper and they'd be done tapering in March or April, then they're probably to stick with that. I mean, I don't see what the rush is, especially given that if you look at it and if you had some irrational exuberance going on, some of that's being knocked out of the market right now. So in a way, that's sort of a benefit, right? From their perspective, maybe. So, I mean, usually you would expect them to just keep doing what they're doing. And now the question is the dot plots, are they going to increase or lower the number of rate increases predicted? That may maybe change a little. I mean, who knows, but it's really unexpected. I think that it would change very much. Now, of course, the market could read into it. The market could be like, hey, the stock market's going to hell in a handbasket. Fed, come on, are you going to bail us out here and soften your tone or something? I mean, who knows? Maybe they will, maybe they won't. But this is not, at this pace, you're still at all-time highs. You're still really near all-time highs. So to be sitting there thinking that the Fed should respond to this, that would be pretty, they really shouldn't. I mean, look, you're at all-time highs here, so you really shouldn't. So in terms of what I'm settling on at this point, it really looks to me because if you look at everything, look, it could be still that this is a larger correction. It still could be that this thing comes down some more, makes some kind of a base and just settles out, and the market gets used to the rates going up. And maybe the Fed raises rates this year a couple times, and a couple times maybe inflation backs off, and there's still called disinflation. The inflation rate has gone down, that type of thing starts happening. So maybe that's what happens. And then it kind of just settles out and it's clear to start going up, maybe, later this year, something like that. I mean, it's certainly possible. So that's one thing that you could kind of keep an eye out for. But so then what would we be looking for? Well, we'd be looking for some stabilization, right? We're looking for this market to find a low, find a place where it starts going into a range and starts biding its time, waiting for things to settle out. So that might be one of the things that could happen. The other thing that could happen is it could just continue to just go down and down until it gets, be more of a true bear market. So that's the other thing. based on how much damage has been done on all the indices, my bet would be that we're entering a bear market. And so that's really what this video is about. It really looks to me, given the damage that's been done, is that we're entering a bear market. And so there's several. First of all, the damage in like the small and the speculative plays has been pretty bad. I mean, we're talking like 50% plus losses, and we still have selling going on in there. And one of the things that you can look at, bear markets have characteristics. And one of the characteristics is that, the rallies fail, buying the dip fails. And so if we go and we take like an RK and we kind of just look at this thing, what's been happening, what's turned into and what's really happening, you can see that you have a dip, you get this little weak rally, and then it just dips some more. And then you have, weak rally or stabilization, then it dips, then a little rally, and then it just keeps dipping. And this is bear market behavior. The behavior is that you're putting in lower lows and you're putting in lower highs. And this is consistently happening. So this is bear market behavior. So even if even if we weren't down 50% in these stocks, or we weren't down 10% or 15%, this is bear market behavior. The rallies are failing to participate. They're failing to hold, and you're failing to put in new highs, even just 52-week highs, right? Now, a bull market would have a different characteristic. A bull market would you'd be making some progress here. And this is a case where you could buy the dip. So for example, okay, we have a dip. If you buy here, okay, great. You buy, and then look at that. Oh, well, you did get higher, so you did make some progress. And then when you went lower, it didn't go quite as low. So you're making progress. You're working your way up. And this would be a bull market type of a thing. And this is a case where you can buy the dips, because, hey, you bought here, went up, oh, darn, gave most of it back, but still, you can even buy some more, and that you're still getting ahead because your lows are higher, your highs are higher, et cetera. So this type of behavior kind of really points to the fact that, hey, we're in a bear market. And so therefore, what does this mean? The real question really then becomes, okay, we're in a bear market. But we're not in a bear market yet. So this is what I really want to say is we're not in a bear market yet, but we're transitioning into a bear market. So even now, after all the damage that's been done and the speculative stuff, we're just transitioning into that bear market. This is early stages. We're just breaking the 200-day moving average. We're breaking those important moving averages. And it may very well be that we got to do more. It may very well be that we need something where, some kind of more formal top coming in, like a double top or a head and shoulders. So that could literally take a whole year to play out. That's kind of the time frame that you're looking at. So we will see. Given that the markets seem to trade really fast, I would expect, and given that what happened back here in the cerveza sickness onset over here back in March of 2020, see, this thing, it just imploded, and it just went down, and you got your 30% correction just within a month. And so I would expect that, are we going to be able to come back up to near this high? Maybe, but maybe not. So in other words, entering this bear market, we may not have a double top. This really isn't a double top. It sort of is, but it's not deep enough to really be a double top. So it's more of just like a range. So my speculation is that we're going to go down until the Fed is done doing whatever they feel they need to do. And then we'll find some other base and we'll move on from there. That's probably what it is. So in conclusion, let's be careful. All the evidence at this point points us to that we are entering a bear market. And the consequence is, if we look at that and we say, okay, we're entering a bear market, is this going to be over this year? Well, you have to look at it and say, let's look at other bear markets that it happened. So if we go over here, if we're looking at, okay, so here's a great one. This will be the tech run into the 2000, and we had the bear market. So here we are. So if we look, where are we right now in the cycle comparing to this one? Now, Comparisons like this are never, of course, 100%, but we're somewhere right here. This is the 50, this is the 200 days. So we're like somewhere like here right now. Okay. So that's where we are in the cycle. Okay. So we're just starting to enter a bear market where we have this consistent downtrend. In the downtrend, notice it's very violent updrafts within that downtrend. And this is because as you enter the bear market, people are going to try to make money shorting the market. And the problem is when they get scared, they run really quick to cover their shorts. And that's why you get these really violent moves of violent updrafts in the bear market. And you get that because it's driven by the shorts. The shorts are the people that are running in there. It's not the value people. It's not people coming in to buy stocks that's doing this, right? What's happening during these violent updrafts is that, okay, all the people that are making money, like, it starts going up on them and they're worried like, I don't want to give up my profits. So they have to run and cover and they drive it up. But then you run out of buyers. You run out of people that are short and then there's no other buyers coming in yet. And it isn't until you get much later that you actually get this situation where you stop putting in new lows. And here you're not putting in new highs, but this is called a base. And once you have that base, now you're set up for a break above it. And then you have the new bull market start. So in conclusion, we are probably, because looking at here, the 150, the 200, we're like maybe here right now. We're somewhere here. And so that, the implication is that you have like a year of a bear market coming ahead of us if this is an example that we could use. So you probably have a year of a bear market and you have maybe another year of base building before you can move to the next bull market. So to keep that clearly in mind, what does that mean? You have a year of continuing decline in stocks. A lot of the stocks that are already down like 70% stuff, they may not go down much more, but they're not going to go up. And I showed you the example of Cisco the other day where, how it was one of the leading stocks in the tech bust and how it took 10 to 12 years before it got back to where it started. That's why that happens, right? The leaders of today. So, if you're looking at the Teslas, the Neos, the Enphase, you look at all the RK investment speculative stuff, all that stuff could be out of action for a decade. And it could take, right? And then in terms of the major averages like the SPY, like I said, we're probably here. And this isn't 100%, but you're right about there. So we probably have some good rallies to come and then more down decline. You're losing, you're not getting ahead on this one because every rally is just a short covering rally of panic. And then there's not enough buyers coming in to make up for that to sustain it. And it's only when you get down here that the shorts are finally giving up. If you're short and you're here, and it's like, oh crap, it didn't put in a new low. You start to know, see, because on the short side, they're a little more technical and they're like, see, if you're on the short side and you're like, okay, cover a bunch of shorts, comes up to here, start shorting it again up here. And then it comes down and they put in a new low. Hey, that's cool. They still know that they're kind of on the right side. So even when this rally comes up, they still kind of know they have a chance. But once they get here and they compare like this point here at 1 and this point at 2, and it's like, oh crap, we're no longer making progress on the downside. And then on the upside, we really got back. We almost broke a new high. That's when they start worrying. And maybe they'll hold to here because they can have this as well. They can have consolidations that then continue to break to the downside. So they don't know yet. But at this point here, you start getting worried, right? You start really getting worried if you're short significantly because you're like, okay, I did not put in a new low and it's starting to run away at this area here. And so that's how it feeds on itself. So in conclusion, I think that we're entering a bear market. If we're entering a bear market, try to go look at those, look at them yourself, like what happened to S&P, what happened in the NASDAQ. You'll see that, these bear markets can last a year, 2 years. Stocks won't go anywhere for 2 years because you have to have the decline stop and then you have to get that base in. And then from there, then you can start moving out. You have to watch for what's going to be the leader on the next cycle. It's a new cycle now. So just because Tesla was the queen of the ball doesn't mean Tesla's going to be the queen of the ball on the new one. That's it for this one. Bye.